Hello, everybody. My name is William, owner and founder of ExclusiveAnnuities.com. Thank you for tuning in. Today, we're going to be going over an educational video, right? Breaking down the 4 different types of index annuities, what to look for, pros and cons, and also how they can be structured, different contractual guarantees inside of those products. And then, of course, finding the contracts that best suit you. If you're new to our page, please like, subscribe, and share. First things first, I am going to pull up our website. You can always check us out at exclusiveannuities.com. We're 5 stars on Google, 100% recommended on Facebook. We'd be more than happy to sit with you, help you, guide you during your decision-making process if you're looking at annuity contracts, don't know which one to pick, right? There's over 1,000 contracts on the market. We're an independent firm, and we operate in the client's best interest 100% of the time, right? And we will give you a truthful response and analysis and presentation on what you might be looking at, what you need to accomplish, and then help you build that bridge as you head into retirement, or maybe you're already in retirement looking at different annuities as a possible solution. We can definitely help guide you through that process. So exclusiveannuities.com, you can always check us out here. My name's William. I am the owner and founder of the company, right? So you can always go here, check us out first. There's our executive vice president, Brady Pelzer, our senior advisor, Patrick Esposito, and our other senior advisor, Dylan Bangs. And here, you can always click on our Facebook channel. Check us out here. We're 100% public. We put all of our videos and content and material out for the public to view, watch as an educational platform. And our Facebook channel, you can go to our review tab, see that we're 100% recommended here. All of our clients' testimonials, different individuals leaving comments about working with us, and so on and so forth, which is big, when you are looking at different annuities and trying to pick the right advisory to work with. So we do put that information out public. Like I said, we're also 5 stars on Google. You can go right to our Facebook page, look at all of our content, videos. We post a lot of educational material. You can see the awards that we get every year and so on and so forth, right? And we're more than happy to bring the marketplace to you. That's what we do. We bring the marketplace to you. We shop the highest guaranteed value propositions on the open market based on today's rates, today's pricing. And we use software most of the time to analyze those guarantees, show you the highest ones in your state, your age, and basically what you're trying to solve for, whether that's accumulation, income, legacy, principal protection, long-term care, chronic illness, you name it, we can look for it, right? So there's our website, there's our Facebook channel. You can always go to our YouTube. So if you go back to our website, you can click right on our YouTube channel, and this will bring you right to our page. We have almost 1,400 subscribers at the time. It's April 19th, 2025, and we post a lot of content, right? All of our videos are recorded for the general public. You can certainly go through, watch them. If you are watching this video, I'm assuming that you found us on YouTube. Please like, comment, share, subscribe, give us a thumbs up on the video, and we more than appreciate your support. So today, what we'll be covering is the 4 different types of index annuities. Now, some might argue that there's more than that, right? And we like to categorize these items one by one to make it simple for the customer or the client to understand, right? When you go into annuities or you look at them, right, and maybe you're new or you already had one before, the market is forever changing, right? So there's always going to be different types, different products, different companies, right, that you can search through. But ultimately, identifying what you want to do with your funds, whether that's non-qualified cash, IRA, Roth IRAs, old 401k, or an inheritance, whatever that might be that you're thinking is, should go into annuity, or that's what you're considering, make sure that you just schedule a call with us, right? We'll go over everything that you need to know when looking at contracts. And you can go there by visiting our website, clicking Speak to an Advisor now. It's going to bring you right to our calendar, my calendar. And you can go through, pick your time zone, and then just schedule a meeting. We are pretty booked half of the time, but if you book, we will show up and we will do a thorough job, explaining everything to you, answering any questions you have and things like that, and so on and so forth, right? So today's exclusive annuities mentorship class, like I said, 4 different types of annuities. Now, the first one I want to start with, I'd like to categorize them by option 1, 2, 3, and 4 to make it simple for the consumer to understand. Once we narrow down a specific type that we like, the concept, that's when we shop and find the highest probable guaranteed value propositions for you on the open market. Now, we work with over 65 different companies. We're an independent firm. We're not incentivized to write one or the other like most firms, right? Because that's the reality, depending on what type of agency you're working with. We truly shop the highest guarantees for you. So if you get on a call with us or you call us, right, that's exactly what we're going to do. Now, very simple. Option 1 to 4. Option 1 is an index annuity specifically for one, principal protection. This means you're trying to take money off of the table, minimize risk, make sure that you don't lose, but also have an accumulation, a safe growth opportunity within the contract, right? So we like to call option 1, index annuity for growth. The purpose of the contract, right, is to maximize accumulation or account value over time, right, with principal protection, right? You buy the contract because you're not going to lose money, but the accumulation-based annuities, option number 1, they're specifically designed for growth, right? So if it's an index annuity, they're coming with index allocations that you can allocate to year to year or biannually, right? So that could be the S&P 500. There's a whole nother training I can do on index allocations, which ones to use, which ones to look out for. Also pricing as far as participation rates. Does it have a cap? What's the spread? What's the fees, right? We can identify the strongest contracts for you, give you our honest opinion on what you might have been presented. But option number 1 is specifically for accumulation. So these contracts come in either 5, 7, or 10-year terms typically, and they are annual point-to-point crediting terms. So if you go in today, right, and you sign up for the account, the contract's issued, whatever index allocations you're in, and there's a variety to choose from, right? We can help you choose them, the appropriate ones, the best ones. But if you're doing an annual point-to-point crediting term, the money's going to credit annually. Your interest is going to credit annually, which means today's April 19th. If we sign up today, on April 19th of next year, whatever that index did as far as growth, point-to-point, you'll get an interest earning at the end of the first contract year, minus caps, participation rates, spreads, things like that, all right? You can also do a 2-year point-to-point allocation. Those you have to wait 24 months, so 2 years for it to post and lock the earnings to your account. 9 times out of 10, the carrier will give bigger participation rates, larger caps on the 2-year allocations, right? Sometimes we're a fan. Most of the time we're not because we have to wait 24 months for it to post and lock earnings, right? The annual point-to-points, they're going to credit annually, and then you can reset and rebalance them once a year. That's basically any index annuity that's specifically for growth and accumulation, right? There also is 3, 4, 5, 6, as large as 7-year point-to-points that you can use, depending on the contract, how it works. But these, products, index annuity for growth, are specifically for safe growth without an income guarantee, right? So they do not have an income guarantee, these contracts. They usually come with no fees, right? Unless you optionally opt in to have a fee. So the fee could come in the form of an extra liquidity rider, right? Most of these contracts come with 10% free withdrawals a year. You can opt in on some contracts to take a 0.9% fee or a 1% fee, and they'll give you either extra liquidity, right? Which means, 10% you could take a year. If you skip a year, that will turn into 20%. Other contracts come with that benefit without a fee. They're out there, right? And then the other type of benefits would be like ADL, chronic illness enhancements. There's riders that you could take like that enhance the payouts, the liquidity if you become chronically ill, right? And then you also have like your traditional return of premium riders, which allow you to get all of your premium back within the contract year if you decide to get out of the contract, right? So those are in there, right? They're out there. Most of the time, these type of products do not come with a fee. The number one, index annuity for growth. Earnings are based on performance of an underlying index like the S&P 500, which, like I said, usually comes in a cap, spread, or participation rate, but you can't lose. There's zero downside risk. There's no income riders typically in these type of plans, and they can allow for free withdrawals up to 10%, right? It's best for clients that are seeking growth potential with protection against market downturns. So that's first and foremost. Clients who don't need a guaranteed lifetime income but want tax-deferred growth. So the growth in these contracts, if it's non-qualified money that maybe you're allocating currently to a CD, well, you can do that in an index annuity, right? And defer it for the contract term and then roll it over when you're done and continue to defer it, right? So a lot of different strategies and concepts we can look at there. IRA, Roth IRA, always going to be deferred, okay? So that's number one. Hopefully everybody got that. Very simple. There's a handful of contracts that we like on the open market for index annuities specifically for growth. I always tell people this, right? Annuities that are designed to do one thing very well usually do that one thing very well, right? If it's an option number one, index annuity for growth, right? The purpose of the contract is one, principal protection, and two, growth, right? So the contract, the carrier is going to price them differently as far as growth potential than, say, an index annuity with an income rider, right? Because that contract is good at something else. And that's what option number two is, right? So we have the option number two, that's an index annuity with an income rider. This example is fee-based. Now, there also are contracts, there's index annuities that are sort of like hybrids, right, that have a growth part to it. Then they have an income option. There's no rider fee on them. That's option number three. We'll go over that in a second. But this one is an index annuity with an income rider that's fee-based. Now, whenever you take that fee in an index annuity with an income rider, in simple terms, what that means is you're maximizing the income, right? So they're going to give you the most amount of income as possible. And because of that, when you activate the income rider, the long-term value of the asset will eventually diminish, typically around the 10 to 15 year mark of you taking income, right? So the pro in the option number two, index annuity with income rider, is that your income is going to be the highest that it can be. Right? Every year you defer and don't take income. So say you buy one of these and then you say, I don't need income for 3 years. Well, when you take the fee, they're going to give you a guaranteed increase to your income every single year because you took the fee. So it's specific. You can narrow down exactly what the income will be at each specified age when you take the rider fee. That's the pro, right? The pro is it's very straightforward. It's a contractual guarantee. You know exactly what the income will be, right? The con is that long-term value of the asset will diminish, but you'll continue to get the income for the rest of your life. Now, some of thers products come with doublers for chronic illness, nursing home, confinement care. That's a whole different training that I can do. There are other videos on the YouTube where you can watch those, right? And that's what it is, right? So for an index annuity with an income rider, fee-based. Now you get a guaranteed withdrawal rate based on single or joint life. You have a roll-up rate, right? When you hear people say it's a guaranteed 8% a year, right? They're not talking about option one. They're talking about option two. That's a guaranteed 7, 8, 9% roll-up fixed rate to your income value, which is in these accounts what the carrier uses to dictate your income at the time that you activate the income option, right? So just so you know, there's a lot of people that come meet with us and they say, oh, well, this guy said it's a guaranteed 8% a year. Well, yes, he's talking about option number 2, which is an index annuity with an income rider. It's a guaranteed, that's not real money that they're giving the 8% to. It's just used to determine your payout factor at that age. It's not the tangible asset value that's getting the 8%. It's the income value or the benefit base or the income base. Each carrier calls it something different, right? So long story short, that's what it is with these, right? Guaranteed lifetime income. You can count on the check depending on the claims paying ability of the carrier. We like to use A+ rated carriers for these, right? These contracts, we plug in your age, your state, how long you're waiting to take income. We can find the highest guaranteed product for you on the open market. Preferably like to go with an A+ rated company in this scenario. Because you're going to be taking lifetime income, right? We don't want you taking lifetime income from anything less. So this is best for clients who want guaranteed lifetime income, right? Clients who are willing to pay a fee for exchange for income security, clients who want to defer income for a higher payout. So think of it like a pension replacement. The only difference is you're going to have a asset value for a little longer as opposed to the pension, right? Less death benefit later. Okay, so whenever you say option 2, index annuity income rider, fee base, just think after you activate the income rider, give it 10, 15 years. Best case scenario, you really won't have any more money left in the account because you're getting the maximum amount of income, right? Some people look at those contracts and say, William, it's the best thing I've ever seen. Other people look at the contracts and say, William, I would never do that in my life. So it's really just dependent on the person, the individual. How you would want to structure that. And, it's a preference as well to the consumer. So next one, option number 3 is an index annuity with income option, but no rider fee. So this is a kind of a blend between option number 2 and 1, right? You have growth-based potential. So when you go into the contract, it can provide a guaranteed lifetime income. But the difference between this one, option 3, and option 2 is your deferral. So when you sign up and let's say you're waiting 5 years to take income, right? On option number 2, because you took the fee, they give you the guaranteed increase every year. Doesn't matter what the indexes do. It's a guaranteed increase to your income value. On option number 3, you don't take a fee. And when you defer income, it's based on performance of the indexes in the contract. That's what calculates your roll up, your increase to your payout for when you activate the income option, right? So there's usually no fees. These are for people that are okay with a little less income, don't want any fees in the contract, want to preserve the asset's value long term. Because with these, if you put money in, right, and you let it grow for 5 years, based on how much the indexes grew in that 5-year period, right? That's what your specified income would be against your payout percentage in the contract, right? When you activate the income rider and take income for 15, 20 years, you're going to have, hypothetically, because it's an index annuity, you're going to have more money left over later for death benefit purposes and things like that, long-term value of the asset. So think of it this way. Option 3 is you take less income, but you have more money in your account later. With option 2, you take more income, but you have less money in your account later. Make sense? So these are good for people that want growth, accumulation, but also might want to be able to turn an income option on at some time and have another form of guaranteed income in the house, right? And they're also priced better. They're from a growth perspective, they're priced better than option 2. They're not as well priced as option number 1 because, like I said, if it's good at one thing, it's going to be good at one thing. If it's good at multiple things, right, it's going to be okay in multiple things if it's priced that way. So these, we can find the highest one for you on the market like we always do with all of our clients. There's specific contracts and things you want to look at outside of just what the income is, right, depending on other goals you might have. And that's option number 3, right? Lifetime income is guaranteed, so this is guaranteed income. There's no ongoing fees or maintenance fees. You have good growth potential, right? The income payments are typically lower than ones with an income rider fee, right? And income is usually based on simple withdrawal provisions, right? And so these are good for client who wants lifetime income but are sensitive to fees, right? Want to preserve the asset's value better. Clients who are more comfortable with a simpler payout structure. Clients who prefer not to reduce their account value long term with ongoing fees, okay? And number 4 is an index annuity with legacy death benefit options, right? And just so you guys know, all of these contracts can be structured to have some sort of long-term care need, right? Or chronic illness, especially on 2 and 3, right? So on the 2s and 3s here, if there needs to be a doubler for income, if you get chronically ill or nursing home, we can attach those inside those policies as well. That's why I didn't do a separate section for an option 5, because they go right into option 1 through 4, or preferably option 2 and 3, right? This one is index annuity with legacy death benefit option. So this one, index annuity with legacy. So purpose is to maximize the death benefit for beneficiaries. So these are benefit-based driven accounts. So essentially what happens is you fund the annuity, you get a certain bonus to what's called your benefit base, which benefit base also comes in option 2 and 3 typically. But in this example, the benefit base can be used for death benefit purposes. So if we put $1 million in an annuity on an option number 4, and the benefit base bonus, which is sometimes most of the time how these work, is 50%. That means if I put in $1 million, right, my benefit base is going to start at 1.5 million. After that, right, the 1.5 million, not to mention, is not the asset, the accumulated value. That's your benefit base value. It can only be used for either income or death benefit payout. Now, there's $1 million in the account value, 1.5 in the benefit base, right? Now, when I grow this account over 10 years, there's certain features where if the index does 5%, they'll give the benefit base 10%, right? Or if the index does 5%, they'll multiply it by 150% and add it to the benefit base. And what that does is the bonus was applied to the benefit base, and they'll grow the benefit base more than the accumulated value, because when you get down the road and say you pass, let's just say on year 10, because of the benefit base bonus and the extra enhancements to the benefit base every year the annuity earned interest, that benefit base might be 4 million. The account value might only be 2 million, right? A lot of these come with no fees too, but it's an awesome way for Roth dollars, right? If we're speaking Roth dollars, garnering leverage with the annuity, perfect concept for maximizing legacy inside of this type of annuity insurance product, right? So long story short, you get 10 years down the contract, the account value might be 2 million, the benefit base might be 4 million. And when you pass, these carriers will give you an option for your beneficiary to either take the account value as one payment, so they can take the 2 million as a one-time payment, or they can take the benefit base over a 5-year period, right? So think of it. If you fund this type of contract with $1 million and it's Roth money, right? You start with 500,000 plus in Roth, right? So million goes in, 1.5 is your starting benefit base value, right? But it's Roth because you put in Roth money. It can also work for non-qualified and IRA money, but there's leverage there, right? So when you pass, they're paying out the benefit base over a 5-year period. If it's Roth money, it's all going to be tax-free. So those are the 4 different types to categorize. Hope you guys got value from the call. Like I said, option 1, specifically for growth and accumulation, no income guarantee. The way you take income is interest income, never touch the principal. Usually come with no fees unless you opt in for one. Option 2 is index annuity, the income rider, more income, less account value later. Can structure it for long-term care or chronic illness, doublers in there. Index annuity with income option with no fee, right? That's option number 3. That's sort of one of our more go-to. We show all these, right? So if you sit with us, we're going to show you option 1 to 4. let you make the determination of what we're trying to solve for, and then we narrow down those specific contracts. Option 3, less income, right? More account value later. Option 4, specifically for legacy, benefit-based driven. Hope you guys got value out of the call today. My name is William Rapp, founder and owner of exclusiveannuities.com. Click the link below, schedule a meeting with us. Like I said, if you'd like to meet with us, simply go to exclusiveannuities.com, right? You can see my face right there. Speak to an advisor today, and we'd be more than happy to help you and guide you during your retirement journey. Talk to you soon.